Good afternoon to all the listeners, and welcome to another episode of our podcast series called Investment at Your Fingertips. In our last episode, we discussed the risk and returns on investment. Today, we'll be discussing different investment strategies and also will be evaluating investment opportunities. I am Mohammad Saif and I am the host for this session. We have a financial expert with us, Vikram Shakti, who will be explaining different investment strategies, and we will also try to find out what are good investment opportunities. Vikram,
Hi, Saif. How are you doing?
I'm good. Welcome to the third episode of our podcast series.
Thank you. Thanks for having me again.
How will you start explaining to our audiences about different investment strategies?
See, there are multiple investment strategies which exist in the market and which are at our disposal. And we cannot finalize on one strategy and say that that is the best strategy which we can use. Okay, each and every strategy comes with a baggage which will be suiting for few set of individuals.
Okay.
So to decide upon the strategy, first you need to have a thorough risk assessment of what is the risk taking ability of you before you want to enter the investment world. That is the thing you'll have to figure it out. Once you have done that, there are so many investment strategies which are already there, and you can opt for more than one investment strategy also. It's not that if you are using one strategy, you cannot go out of it and use another investment strategy.
Okay. So, what should be the basic strategy for beginners? How should they start? What about the investment instruments, the investment
The basic
objective, and
the
long-term goals?
basic strategy for any investor, whether he's a beginner or if he's an expert, is, see, you should follow two rules. Rule number one is you should not lose money. Rule number two is you should not forget rule number one. That's the first thing, right? So you should not make losses. That should be your basic strategy before
Yeah.
you're starting with it. Along with that, you can you should have a thorough research
Mm-hmm.
to back whatever the calls or position you're taking.
Mm-hmm.
You should not enter any position just by listening to someone, like we discussed in the last episode. Someone gave you a tip. You might not know what research that person has done to give that tip, right? So unless you know the research
Mm-hmm.
which has gone into that call,
Mm-hmm.
it's better to avoid those calls. Another thing is, if you diversify rather than investing in single stock, if you diversify and put it across more than one stock,
Mm-hmm.
the risk is mitigated. So that using that strategy actually helps you minimize the risk.
Okay. So, whenever we talk about investment strategies, we'll always end up listening about growth and this value investing strategy.
Yeah.
So, what is actually growth and value investing? Can you please explain it in the most layman terms for the beginners investors?
These are two types of investment approaches which anyone can opt for.
Mm-hmm.
Growth investment strategy, like as the name says, you will research the companies which have huge growth potential in the coming years,
Okay.
and you anticipate them to make good revenue, increase their margin in each and every aspect, and you invest in such companies.
Mm-hmm.
Okay, and at the same time, value investing is something you have to do research to find out which are the stocks in the market which are undervalued.
Okay.
The company might be actually good, the fundamentals will be actually good. It is showing growth over the years,
Mm-hmm.
but still for some reason it will be undervalued in the market. Maybe the demand is less, or there was some issue which was there in the company in the past, and now it has been sorted.
Mm-hmm.
So if you invest in such stocks, it is regarded as value investing.
Okay.
So basically identify undervalued stocks
Okay.
and you invest in, इसमें फंडा ये होता है कि भाव आपको सस्ते में मिलना चाहिए. ठीक है, आपको उसको you know the value of it, how much it is worth in today's market. If you can take that call and invest in that such type of strategies are called value investing. Like there are two, one international god of investing, we regard him as, and another one local Indian guys like Warren Buffett and Jhunjhunwala. They fall in the second category. They are the value investors.
So we can say that value investing needs expertise. Like you should be master of
both
research and analysis.
See, both growth and value investing needs expertise. At the same time, value investing is one step ahead. You have to show some dare. Like you really back the company when it's going through the rough times, right?
Okay.
So that is when you should be more patient. And at the same time, growth investing, like you can you will realize you'll get the returns. You'll realize the returns sooner than the value invested stocks, because the value, if any company is undervalued and you invest at any point of time, there are chances that it will go further down, right? It can plunge down even further before before the trend is reversed and it bounces back. There will be like losses also which you might incur, but you should not lose your temperament that time and stay confident about your call. Stay invested in that stock longer to see returns.
Okay. So does this growth and value investing only works in equity stocks picking only, or does it work in mutual funds also? Because I've seen many mutual funds, like they have this specific growth mutual funds, and some have like value funds. Like, what are the differences for layman investors? Like, is this can a layman investor, utilize value investing with value mutual funds?
Okay.
Yeah.
See, the same way there are mutual funds which target companies. So their strategy will be growth investing, obviously. And there are at the same time there are funds which target the value undervalued companies. So that will be value investing. So in both these funds, you should like again do your thorough research before you're getting into any fund and see what's the strategy they are using. So they would have defined in the fund only what type of investment they are. Sorry. What type of fund that is, and so if it is saying as the growth, some company's growth fund, right? So it is actually growth investing. So that's the main criteria to categorize any mutual fund among growth or value investing.
Okay. So like which one is more ideal for layman investors? Like I'm still not getting it. Like actually, what should a beginner go out for? Like what a beginner should go for growth investing, or he should be looking out for undervalued stocks or value mutual funds? Like,
see, it depends on his risk appetite, right? See, you being an investor, you would want to earn returns in the next 6 months to 1 year. So in that case, you can go for growth investment.
Okay.
So if you can hold on to the investment, like you are ready to wait for more than 2 years, or even might be 3 years, in that case, you can go for value investing.
Okay. So I think I'm much clear with growth and value investing. Like next, move on to next big subcategory of investment strategy, that is active and passive investing.
Yeah.
So what exactly is the difference between active and passive investing?
See, active investment is, as the name itself says, you're more active in the stock market. You're doing more number of trades. Okay, you should be able to exit from one position and enter the position again on the same position in the same stock or in a different stock, like more frequently.
Okay.
So by doing so, what you're doing is you're increasing the transaction cost, the brokerage, whatever you pay for the broker, right, for dealing those trades. So that will be higher. At the same time, you'll make sure like you are booking profits in each of the trade you are executing. So this is for those people who want to be like active in the market, want to like see those charts, technicals of those company, and like they don't want to book losses at any time. So they will book minimum losses. They'll not like wait with any particular stock, even if it is going down. So they'll just simply exit the stock and they'll take position another stock. Okay. So these are the people like whenever we see market crash or market is falling, right? So we'll get to hear the news that it was because of panic selling. That panic selling, it results from these kind of people who don't want to take losses at all. Okay. So they want to book profits then and there. Okay. The other type is passive investing, in which like he doesn't have much idea. Like so either he has done his research or he has taken any advisors advice and he invested in a stock and he's not like switching between the stocks too often. Okay, he'll say he'll buy a stock and he'll back that stock for a longer period of time. So if he has actually made a wise call in buying the stock and he has waited for a certain period of time, he will book returns in that. Okay. And along with that, he'll like also bring down the transaction cost, which active traders have to do.
Okay. And I think in the long term, the passive investor would be more beneficial because, eventually if you see Nifty and all the markets, eventually in the long term, they go on upside only.
Exactly.
Like so what happens is what most initial and investors and beginners, what they try to do is they try to become active investors, they try to take advantage of the market, and then they end up losing the amount because they exit at the wrong time and they enter at the wrong time.
Yeah, yeah.
So I
It
think
happens.
if you are a beginner and who doesn't know much about investing, the active strategy is more beneficial.
Yeah, and see, active, if you go opting for active investment, so you should like make sure you are keeping a tab on each and every small news which will affect the company which you have bought in. Okay, if you are a passive investor, you just see the trend, the macro factors which are there, which are affecting the market or the industry overall, and you invest in that particular sector or industry, and you back it, back those companies to give you returns over the years. So that's the main difference between active and passive investment.
Okay. So, like, what about mutual funds? We keep on hearing like mutual funds are actively managed, and there are index funds who are passively managed. Okay, they are just copying the index.
See,
Their
index
portfolio
funds,
just represents any index.
any mutual fund which is like not an index fund now. Will be fund managers will actively be looking for money making opportunities.
Okay.
They will be like actively trading in the market.
And the fund manager is an expert.
He's an expert. So like the least of their concern is the transaction cost, which they know they will they will they don't have to worry about that because they'll be making significant profits in the trades which are executing.
Yeah.
So index funds, when we say like they don't do much, what they do is they just replicate the index fund. So we all know what is an index, right? So Nifty 50 is an index. So there are 50 top most most famous listed companies of India which are traded in the market. That's what Nifty 50 constitutes of.
Yeah.
And in among those 50 companies, NSE has given weightage to each and every company. Like Reliance has the highest weightage.
Yeah.
Next is TCS. That's how the weightage will be. The any mutual fund which is like index mutual fund, so they'll just try to replicate the index.
Okay.
So they'll if the surplus is 100 CR, so they'll buy the same percentage of Reliance stocks, the same percentage of TCS stocks.
Okay.
So in that way, they would have replicated the whole index.
Okay.
So that will be directly linked to the index performance. As the index moves up, the portfolio of the mutual fund portfolio also goes up. So if the market goes down, so it's that way it's directly related to the market. So that way, so they very like NSE, they rarely change any. I mean, they'll notify people before they're adding a new company or removing it from the index, right? So only when they do that, fund managers only will have to take action in the fund also. So that way, it is passive investment.
Okay. But these also in the index also some companies keep on adding and some companies keep on removing. Like we have seen many companies coming in Nifty and we have seen many companies going out of Nifty 50 index in the history. Okay.
Yeah.
Like if a company is doing good, it will be added to Nifty 50.
Yeah.
Okay. So eventually all the good companies will be there in Nifty 50.
Yeah.
Okay. So like isn't it an easier way to invest, like all the best invest in all the good companies? Like why do I need active management? Why do I need actively managed mutual
See,
funds?
that depends on the individual, right? That is your perspective. You feel that is safer.
Yeah.
Because I mean, you don't want to take too much of risk. You just want to go with the market. So being a risk, I mean, I am a person who likes to take risks. So what I will feel is I would want to, my overall agenda of investment will be to earn more than the market.
Okay.
So if I just invested in the invest stock, I'm confining myself to the Nifty stocks or the market potential. So how much ever the market is gaining, you're directly gaining that much only, not more than that. So if you do a little bit of more work over there and proper research, and if you invest in good companies which can give returns better than market, you'll actually beat the market returns, right?
Okay.
So that should be the main agenda.
Okay. So the expense ratio that is considered as the cost of mutual funds, like that is also different in active and passive mutual funds. Like in index fund, it is very low, and in actively managed funds, it's quite high.
Yeah, it's for the same reason. Expense ratio, if you want to put it in, I mean, layman terms, it means the cost of maintaining a fund. It includes the fund manager's fee, which he'll be charging for his service, and along with the transaction cost for each and every trade. For every trade you buy and sell, you have to pay a portion of it as brokerage, right? So active funds, the transaction cost will be more because he'll be doing more number of trades. At the same time, passive trades, he doesn't have to do maybe a trade in 1.5 year also. If he has replicated Nifty, Unless Nifty removes one company and adds a new company into that, he doesn't have to do any trade at all, right? So that's why the expense ratio will be less in passive mutual funds.
And it seems justified also.
Yeah.
Because the fund manager is doing his effort. Now, so we
Yeah,
have to
and
pay.
see, and in active funds, he's more actively researching, and, I mean, to finding out new opportunities and new stocks to invest. So he doesn't have to do that much in passive, wherein all the work will be done by NSE people. So you just have to replicate the same thing. So that's why expense ratio is less in such funds.
Okay. So I think we are quite clear with the active and passive investing as for now. My next comparison of a strategy would be like dividend and coupon payment. Like what happens is many people when they receive dividends, they just spend it. They just get happy. Like I'm talking about myself. What I do is I receive the dividend in my bank account. I'll just spend it over the weekend. What should be the ideal strategy for beginners? Like how should they handle the dividend and the coupon payments they receive on bonds?
Dividends is basically the profits which are distributed from the company. So whatever the profits they would have made after paying the taxes in that period. If the board of directors, if they decide and they agree to issue the dividend in that period of time, they'll also decide the percentage. So it will be given out to all the shareholders. If any particular shareholder is holding that shares in that exercise date, whatever the date they would have decided, so they'll be receiving the dividends. So they're basically distributing the profits which the company had made into shareholders is not coming back. It will directly go to the.
But what about the companies that are not giving the dividend? They are also booking profit now. But
I'm getting there. So we cannot categorize that whatever company is paying good dividend is a good company, and whatever company it doesn't pay dividend at all, it's bad company. So we cannot categorize it like that. Okay, so whatever dividend it has paid out now, it is not coming back to the company. Instead of paying the shareholders, if they had reinvested the same profit in some other company projects or buying assets or increasing in the expansion plan or plant capacity, whatever it is, so they will actually give more potential to increase the revenue over the years. The company can grow in a faster rate. So I don't know. It completely up to company thing why they choose to give dividends or not. So what we can assume is like whatever company they don't give dividends, right? We can see the share price like move just one way. There are high chances that it will. There are no chances that it will fall down or plunge. Most of the times, it will keep on increasing over the period of time. So if we want to like check the same thing, we can like see the costliest stock which is there in the world today is Berkshire Hathaway. Each share costs around I think 3.5 to 3.75 crores. So that is because you know who owns the company. And since the time it's in corporation, they have never paid a single penny of dividend. So whatever they have earned, they have reinvested back into the company. Ultimately, the shareholder is getting benefited.
So what happens is like when the dividends are not distributed to the investor, it gets reinvested in that company.
Improves the share price as value.
And it gets compounded over the years.
Yeah. At the same time, if company is paying dividend, we can see that there will be a correlation between the share price. See, it's actually like decreased by the same amount. Of which they would have paid the dividend. So the pattern is there.
That's why I've seen like the companies that pay a dividend regularly, their prices never go up. Like
they never go up. They'll usually be oscillating between a particular range. It will never break out of that price range at all. Because people also know that this company pays dividend.
But at that time, what happens is like people like me who just spend the dividend and they do not reinvest. They never get this long-term capital appreciation.
Yes, exactly. See, our approach towards the dividend paying stock should be you book the profits. I mean that you take the dividends as like check credited into your account. Then you exit from the stock looking at the nice price range so that you make profit there also. And again enter before the company issues another the next dividend. Okay. In that way, you're making profit on both the levels. That's the only. It's called like.
But generally, the prices of stock come down by almost the same amount that the dividend is generated, like almost similar amount. So whenever what happens is like if a company's dividend is giving dividend of 10 rupees, suppose their prices will generally come down by 10 rupees only.
Yeah, for the same reason. So people, they know the share price will not like reach sky or like beyond that after that point, because it is giving dividend. It will be giving in the future also. What they'll do is, now that they've already received dividend for the holdings, they'll try to exit the position. More people will behave the same way, so that the supply for that particular stock will be more. So the price will go down. So it will be in the same range of the dividend. It will not be exactly the same amount. It will almost be the same.
So next time, whenever I receive a dividend, I should reinvest that to buy more stocks or add more stocks.
Yeah, or buy another investment rather than just spending it across, because anyway you will be facing the same loss in that particular stocks plunge also, right?
Yeah. So, what about these cyclical industries? Like there are certain sectors that only perform during certain, seasons or periods. Like you can see the AC companies doing well during the summers, and obviously we see alcohol companies doing better in winters. So, what's the strategy? Like, can layman investors use this cyclical sectors to take profit out of it?
See, these are also called seasonal stocks, because they'll perform really well in a particular season. Like you rightly gave example of the AC industry. Uh, Most of people prefer to buy AC during summer when they cannot tolerate the heat, right? And same with the alcohol also. Even though I don't completely agree, because I feel that's a recession-free business, and throughout the year the demand will be there. No doubt. But during the winter, the demand even spikes up. So that's the main reason. I mean, it's not that like the company is directly making that profit in only in that period of time. So what happens is demand for those stocks will be high in that period. Market usually runs on emotion. Okay. So as people see more and more people are buying AC, the people who are investing already, who are investors already, what they'll think is all the AC people, like AC manufacturing company, they will perform well, then the returns will be good this year. So that's what creates the demand for such companies. So it has been observed over the period of time. Like that's how the pattern runs. And there is something also called as Santa Claus effect. I'm not sure if you know that.
No.
Santa Claus effect, like it's observed post Christmas. Like it's in the last 5 sessions of any calendar year and the first 2 sessions of the January. So over there, it has been witnessed, like I'm talking about the last 60, 70 years of data. Every year, the market like increases, the overall market across the globe, across the globe increases by 1.22%. So the reason behind this is most of the FIIs or DAIs, institutional investors, will be on the leave during Christmas, right? They'll not be doing trades. So they'll not be taking any positions. So bulk deals will not happen. So whoever is trading at that in those sessions, it's like the retail investors, you and people like you and me, basically. So at the same time, they are the ones who are driving prices, and that season being the gifting season, end of the year, the New Year resolution, so many pictures will come into place.
The festival season.
So any investor is only bullish about a particular market. You'll rarely find bearish investors. Bearish person will become by his like nature, or if he is like too much into research and like if he is backed by too much of data that the market will come on, then only then he will have a bearish opinion. Unless that is the case, all the retail investors are usually bullish. So that's what drives the Santa Claus effect. It's a real thing actually. So you can expect all the indices to go by 1.5% in during the last 5 sessions of the December and first 2 sessions of January.
So our next question was related to that only. Like, what are the investment opportunities? Like, do you think that if that is the scene, then we can enter the markets in December and exit in January? Like, how to identify investment opportunities like throughout the year? This is just one scenario, December and January.
See, it gets way too technical. See, October and September month are regarded as panic month because most of the biggest market crashes happened in this month. So if you keep thinking about these things, like how do I explore more opportunities and all, it gets way too technical for it. And if you are a beginner in the investor, I would not advise anyone to do that. So what they can do is they can do proper research before they're taking any position. Check the fundamentals of the company, and back the company to do well in the future.
Yeah.
And at the same time, they should be like, they should also keep a track of how the company is performing. If they see they're not meeting the expectation, they can exit that position, even book losses if there is a need, and take position in the new stock.
Okay.
That is one thing. The another thing is timing the markets. If you you should also not buy any particular stock the moment you get to know it's a good stock. You follow the stock for a period of time. You'll get to know the price range in which it is moving. You make sure you सस्ते भाव में खरीदने का, तभी हमको ज्यादा प्रॉफिट होता है ना. That's the whole agenda.
Yeah.
Timing the market. It's very difficult. So that we will learn only after we have spent enough time in the market. So that's the second thing. Thing. Time in the market. Time in the market and time in the market.
Yeah, they both are completely different thing.
Completely different thing, but we should keep on. I mean, we should be taking care of these two things, giving equal weightage to both. Then only we can make like good trades and value maximization can happen.
Okay. So, like for mutual fund investors, what should be the suggestion for timing the market and time in the market?
Mutual fund, it will not have that bigger impact unless he is going for lump sum investment.
Okay.
Because most of the mutual fund investment, like we prefer to do like SIPs. Right? SIPs. Every month they will keep on investing rather than one month. So they'll have to set the investment goal properly. Like how many years I'm looking to continue this investment? Is it for 2 years, 5 years, 10 years? And choose the funds accordingly, which are like giving really good returns for that period of time. Okay, that's the basic thing any mutual fund investor should follow if he wants to generate good returns.
I think what happens is with the SIP, the prices of NAV, it gets averaged out. So that
exactly. So if suppose if you have bought if you have invested in SIP and the market was at its peak, you'll get less NAVs.
Yeah.
So you should not stop. You should keep on investing. At any point of time, if market falls, right? So if you are investing the same amount, then also you'll end up getting more number of units, right? So you'll get more number of units. So over the period, the value of each NAV averages out, so that when the market, even if it reaches the peak of its level where it was before, you will be in the profits, not just breaking even for the investment. You will be actually in profits.
Okay. So I'll remember that, and I won't stop SIPs while the market is down. So that was a fun session and very informative. Do you have any final suggestions for our beginners investor, like young investors who are just passed out of colleges and started earning? So what strategy and investment opportunity do you suggest for such
strategy? Will be stay invested for a longer period of time and diversify your investment rather than backing just one stock or one mutual fund. That not only brings down the risk factor, it also gives you the credibility about the stock market. You will start believing in the stock market. If you start believing in it, and if you put your money in it, you will do that research also to get to know about each and everything in the stock market.
Okay. So that will be it for today's podcast. It was a very informative session, and we learned a lot about investment opportunities and strategies. And we have so many more exciting and resourceful episodes lined up in this podcast series. It is called Investment at Your Fingertips. So make sure you keep up with our podcast channel, and also don't forget to subscribe so that you never miss a podcast. Thank you.